I think the next time we have a growth phase, so the next time we have rising PMIs, rising economic indicators, things like that, I think there's a good chance that inflation would return with it. Um, and so I think the kind of the base case I'm looking at this decade is higher average inflation. Now, whether or not we get up to another period of like 9% is unclear because that
Hmm.
was, that was like 15% deficits and injected kind of right into the middle of the economy. Whereas I think what we could experience is a longer and grindier type of inflation.
Lynn Alden, a renowned macro analyst and founder of the Lynn Alden Investment Strategy, believes that the United States will face a continuous battle against inflation for the rest of the decade. Alden asserts that the Federal Reserve's current set of tools may temporarily lower inflation, but it will keep resurfacing on a larger scale until the central bank deploys the right strategies to address the specific type of inflation. In her July 2023 newsletter, Alden examines the concept of fiscal dominance and how significant debts and deficits can mitigate the impact of higher interest rates as a policy tool. She identifies two main causes for higher than normal broad money supply growth that typically leads to elevated consumer prices. The first cause is rapid bank lending, which occurs when a large number of the population simultaneously requires significant credit. The second cause is large monetized fiscal deficits, often observed during significant conflicts like World War I, World War II, and the COVID-19 pandemic in the early 2020s. Alden emphasizes that the current inflation situation is different from that of the 1970s, yet the Federal Reserve is tackling it with tools better suited for the previous era. She presents charts comparing bank lending and fiscal deficits in the 70s and now, showing the dissimilarity between the two periods. Alden addresses the potential implications for the U.S. economy and discusses the appropriate measures needed to combat the current inflationary environment in a recent interview with Blockworks Macro.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
So a lot of people they have recency bias when they think of inflation. Almost everybody thinks about the 1970s. Um, it's basically it's like okay, how do you get inflation down? You become Paul Volcker and you raise interest rates, and that's kind of the axiom that people operate with inflation. But when we look back in history over more countries, more sample size in terms of length, we see that there's actually multiple different types of inflation. There's different causes of inflation. And I think we can kind of put that into three categories. The one category that's present in all the different ones is that there's some degree of supply constraint. We don't have infinite resources. So if you had infinite resources, like let's say our entire economy consisted of software, you might not get corresponding price increases with increasing the money supply. So generally, what you see in times of inflation is that you run into some real world constraint. In the 70s, for example, U.S. oil production peaked in 1970 after almost like a century of just almost every year's up, structurally up, and so we became more reliant on imports, which made us more geopolitically exposed, and so that was a constraint that then made so that larger than normal money supply growth does have pretty tangible consequences. So that's always a factor, and it takes different forms. But then the other two factors are the other side of the equation, which is generally an expansion of the money supply. And then the question is, where's that expansion of the money supply coming from? And there's really two main ways that money supply in the modern economy uh, happens. And the one that most people think of is bank lending. So as banks as velocity increases, as loan creation increases, we get more and more IOUs, basically deposits, chasing a similar amount of goods and services, and so you get inflation. That was in the 1970s. That was the primary driver of money supply growth, loan creation, because you had the baby boomer generation, which was born starting in the late 40s, early 50s. They were turning 25, 30 throughout the 70s and then into the 80s, where they were entering their home buying years, which is when people start making use of credit. So due to demographics reason, we had like higher than normal rates of loan creation, so fast money supply growth, and then you added on. I mean, you had significant fiscal deficits. They weren't huge, but they were there. And then you also had the oil problem, so you had a big toxic recipe for inflation. Whereas you look in other periods, the other driver of money supply growth ends up dominating, which is fiscal deficit. So if you have large fiscal deficits, especially if they're monetized by the central bank, then it doesn't really matter if banks are lending or not. Money's just being handed out. It could be handed out in stimulus checks. It could be handed out in soldier salaries. It could be handed out in, stimulus to build new new manufacturing plants, whatever the case may be. It's going out into the economy, and it's being created from new reserve creation. And so when you get those large fiscal deficits, that's a it's similar end result as money creation, except the causes are different. And that's what we saw in the 1940s, and that's what we saw here in the 2020s so far, which is that the inflation in those eras was not because banks were lending at a higher than normal rate. It was because the government was running larger than normal deficits to respond to what they perceive as a crisis.
Having established that the current environment is not suitable for higher interest rates, Alden notes that the Federal Reserve will persist in using the only set of tools in their toolbox to combat inflation. However, she points out a crucial issue: the Fed's tools are designed to address lending driven inflation, not deficit driven inflation. This fiscal matter leaves the Federal Reserve uncertain about what else to do, as their tools do not directly tackle the core problem. Alden emphasizes another difference between the 1970s and the present period: the federal debt to GDP ratio, which currently exceeds 100%. This high level of debt makes interest rate hikes even more unsuitable. Raising interest rates when the federal debt is over 100% of GDP substantially increases deficits at an equal or larger pace than it reduces loan creation in the private sector. As a result, federal interest expense rises, and the federal deficit widens, ironically exacerbating the very issue that caused inflation in the first place. This situation is likened to attempting to put out a kitchen grease fire with water, which may make intuitive sense but doesn't yield the expected results. In the interview with Blockworks, Alden further analyzes the situation and explores its impact on the inflation trend going forward. The challenging dynamics between fiscal policies and inflation present complex challenges for the Federal Reserve's efforts to stabilize the economy.
The challenge there is that the tool of raising rates is primarily effective at trying to slow bank lending. It makes it less attractive for people to borrow money, and therefore can potentially suppress that excessive rate of money growth. But if large government deficits are what's driving inflation primarily, then higher rates don't really tackle that because governments are relatively rate insensitive. They don't usually say, "Oh, well, now because bond yields are 5%, we're going to get together and we're going to trim the military budget." It just doesn't really happen. And so in practice, you have a rate insensitive source of money creation, and the best that higher rates can do is offset that. So you could suppress the private sector enough that you get inflation down temporarily, but you're not actually addressing the core problem. It's like, it's like one kid ate too much, so the other kid, you have to give them half the food so that your average food per child is the same, right? It doesn't really, you're not actually addressing the problem, which is the one kid ate the other kid's food. Um, and so that's kind of the approach that they're doing because the Fed doesn't really have other tools. It's mostly a fiscal problem, and central banks aren't really in the political position to say, well, it's not our problem. Maybe they should, but that's kind of where we find ourselves in, which is that this is mostly a fiscal driven inflation, and the tools that address it are mostly fiscal, not monetary. And a lot of us in this space, like the digital asset space, and also in adjacent spaces like the gold space. Part of why we're in this space is because we think the current system is unsustainable. If we thought it
Mhm.
was sustainable, we might not be in these spaces. We might be in the existing space. And one of the challenges that makes this environment, say, different than the 70s, going back to the fiscal versus lending concept. So in the 70s, the federal government had 30% debt to GDP. And like I said, most of the money creation was happening from bank lending. So when they raised rates, it would increase the interest expense from the government, which is in some ways stimulative. Ironically, it's pouring money into the economy, but that was a much smaller impact than it would have dampening that loan creation. Right, so it was
Mm.
an effective inflating fighting tool. The problem in, say, the 40s or the 2020s is that if you have over 100% debt to GDP and your deficits are what's primarily causing inflation, then raising rates actually increases your deficit, and it increases the deficit at a higher rate than the impact is likely to have on loan reduction in the private sector because you're expanding a bigger thing faster than you're reducing the smaller thing, which is loan creation. So you get this kind of period where it seems like it's working at first because you're putting pressure on the private sector, you're slowing things down, but then you're building this structural new source of money creation, which is all of these larger and larger deficits pouring into the economy. And so I just think it's a very challenging political position because We don't really have we don't really have the bipartisanship to address the budget directly. And then the central bank doesn't really have the tools to address it, but they have to act like they're doing something. They don't really have the purview to say this is not our issue. So they have to kind of act, even if the act itself is not actually attacking the direct problem. So I think in the near term, disinflation is still winning, but in part that battle's being prolonged, I think, because basically you have, on one hand, you are squeezing the private sector, but on the other hand, you are actually exacerbating the public sector. And
Mm.
so, part of why a lot of these recession forecasts and kind of transfer inflation forecasts haven't materialized as quickly as some people thought is because we're getting to the point where this is actually somewhat stimulative, and it's offsetting some of its own effects. So I think that in the near term, disinflation's winning, but slowly. And I think the bigger risk is that the longer this goes on, eventually the private sector kind of normalizes,
Mm.
whereas the public sector deficits are still there. And then I think we get another wave of inflation in the years ahead. And that'll depend on various factors. Basically, I think the next time we have a growth phase, so the next time we have rising PMIs, rising economic indicators, things like that, I think there's a good chance that inflation would return with it. Um, and so I think the kind of the base case I'm looking at this decade is higher average inflation. Now, whether or not we get up to another period of like 9% is unclear, because
Mm.
that was like 15% deficits, and injected kind of right to the middle of the economy. Whereas I think what we could experience is a longer and grindier type of inflation. Now, obviously, things like acute energy shortages or war or you know tail risks can always give you crazy numbers. But
Yeah.
in general, I think the theme we're looking at is higher deficits, and then structurally deficit-driven inflation, kind of throughout the developed world, and especially kind of centered around the United States, in the decades that follow.
According to Lynn Alden, the rest of the decade is likely to be marked by higher average inflation due to the unchecked real underlying problem of fiscal deficits. She believes that higher interest rates will only contribute to exacerbating this issue. When interest rates rise, the money flows back into the economy, but a significant portion goes abroad, into the Social Security Fund, and to the Federal Reserve, which currently operates at a loss. The majority of the funds owned by domestic sources, including insurance companies, banks, pension funds, and bondholders, including retirees, will have more income to spend. Alden highlights that in the 1940s, interest rates were not employed as a policy tool to combat inflation. Instead, the primary focus was on ending the war, reducing fiscal deficits, and embracing financial austerity. Her analysis of the Fed's inflation playbook raises questions about its effectiveness in the current economic landscape. As we consider the future, Alden's perspective prompts us to reflect on how the economy will navigate the challenges of rising inflation. You are encouraged to share their thoughts and observations in the comments section. For more Daily Dose crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.